Hello and welcome to the third video for Chapter 6. We're going to be going over the contribution margin income statement. Now there are two questions on this, number 9 and number 10 in the homework. Since they're very similar, or they ask very similar questions, I'm going to go over in detail number 9, and you can just transpose or just follow along for number 10. They ask this questions in a slightly different order, in a slightly different way, but it's all getting at the same thing. And number 9 seems to be the more complete question, so I'll focus on number 9. So the second section, we're trying to develop a few tools to help us make managerial decisions, not necessarily how to create balance sheets and financial income statements. And one of the main tools that we've been working up to is all of this cost behavior that we've been tracking in Chapter 6. And we're going to start reaching into our main tool, which is the contribution margin. So we'll talk a lot more about contribution margin in Chapter 7, but we are going to be looking at the differences between what we do on a normal income statement that you studied in the Intro to Financial Accounting, and what a different look at it from inside the company. So there are two different forms. We're going to be looking at an absorption costing method and a variable costing method. Now the absorption costing method is what's traditionally what you learned in the Intro to Financial Accounting, your previous course. And in the managerial course, we're going to be learning variable costing, to compare and contrast. And the requirements by GAAP are that you do absorption costing for external users. But internally, variable costing gives you a little bit better idea about making decisions and what your true costs are. So this question is kind of a compare and contrast. So we're going to do an income statement based on absorption costing and one based on variable costing. The main difference is, where do we stick fixed manufacturing overhead? And you'll see that's the only thing, is between the two, you move them in one category versus the other. But because of that, you end up having to recalculate a bunch of things. So let's look at something that's similar to question 9. You'll be given a bunch of information: selling price per unit, direct materials, direct labor, a bunch of other fixed and variable things. Now, if you notice, we've got total manufacturing overhead. We have fixed portion of the manufacturing overhead. They don't give us the variable portion. We're going to have to figure that out. And then operating expenses. And if you remember, operating expenses were typically things that did not, we called them in the previous chapters maybe period costs, things that did not have to do directly with manufacturing, but were still costs that we incurred during the period. So the traditional income statement that you're used to, which is an absorption costing income statement, is revenue minus cost of goods sold is your gross profit, less your operating expenses as your operating income. So this, we're going to first prepare the income statement like you would under the previous Intro to Financial. And so we will look at a bunch of things here we'll kind of go through it step by step. So looking at our list of information here, sales revenue, well, they don't give us sales revenue, but they give us enough information. They give us that it is, let's see, they give us that it is $49 per item. And how many items did we sell? We sold 13,000 items. When we multiply that out, that's going to be our sales revenue. So that ends up being 637,000. Now COGS, cost of goods sold. Now under this manufacturing environment, remember, we have now started breaking out cost of goods sold into 3 areas: direct materials, direct labor, and then manufacturing overhead. Remember, that's what we covered in the first section of the course, is how to figure out COGS under a manufacturing environment. So we'll do that same thing here. So I'll have this same list of information. In COGS, we'll have to go through and kind of pull out the relevant details. So what is our total manufacturing overhead? Now what we're going to do in a nutshell is, you notice they've given us not the total direct materials or the total direct labor, they've only given us per unit. So we're going to have to back figure a manufacturing overhead per unit, then add the three together and then multiply it by the number of units. So that's what we're doing here. So manufacturing overhead, how many units did we manufacture? Well, we manufactured 17,000. So what was our manufacturing overhead per unit? Well, that ends up being 13. So now we've got our three items that we normally figure out our cost. So this is going to be the cost, and these are the three items. All I'm doing here is direct materials. We're given these two items right here, 18 and 6, right? And we just figured out this one. So when we add those three together, those come to 37. And numbers sold, how many did we sell? We sold 13,000. And that comes up with a COGS of 481,000. So I will kind of point out something here, and we'll plug that into our income statement. What's going to end up happening is there's going to be a difference between the absorption costing income statement and the variable costing income statement. And I initially said it was because of where does fixed MOH go? But there's also going to be a difference based upon calculation. Just pay attention to the points where we're saying we are concerned with the number of manufactured versus the number sold. We are given both of these numbers, and so there's going to end up being a little bit difference, and it's mainly because under one regime, under one way of calculating it, we may use the units manufactured, and the other one we may use the units sold to figure out the number. Now, you think, well, do we gain or lose anything? No, it's mostly a timing issue. All of those costs will roll through. In other words, things that you manufacture, you don't necessarily sell in the same month. But at some point, you will sell more or less, and it will all even out over time. So the difference between absorption and variable costing, yes, it is the fixed MOH, but it's also a timing difference. There will be a slight difference between the amounts, and it's because of when, how many units do you apply to the fixed MOH in which period. Ultimately, when you add it up at the end of the year, it'll all be the same, or over a period of time. So we're going to pull that 481 down. We figured out the sales revenue previously, and now we're going to have a gross profit of 156. Okay, so we're halfway done with this income statement, the absorption costing. So now, just to kind of remind us, we figured out this one, we figured out this, and we figured out this, and now we need to do the operating expenses to figure out the operating income. So that's where we're going next. Okay, so what are our operating expenses? Well, we've got, if you notice, this is a little bit different. We've got a variable portion and we've got a fixed portion. That's like saying the fixed operating expense may be the rent on your headquarters. Doesn't have anything to do with the factory, but that's going to be the same no matter how many units you produce. Well, variable operating expenses may be, well, something that like the utilities, maybe the lights. In other words, if you're running more shifts of employees, because you're producing more, you may end up having more utilities or something like that. So remember, fixed versus variable is based upon one increases or decreases according to the number of units sold, and one does not. So our variable operating expenses, well, we're given that number. And because operating expenses are based upon the number of units sold, we come up with 39,000 here. And the variable total, so this is just this number here. The variable portion is 39,000. The fixed portion is 47,000. So the operating expenses, we figured out the variable portion, we're given the fixed portion. We add those two together and we get 86. So our operating expenses are 86. So carrying that down, we've already had these numbers. We figured those out previously. We now take out the operating expenses, the variable and the fixed portion, and we're given an operating income of $70,000. So this is the absorption costing method, which is the normal method that you see under your financial statements. This is what you would produce. And just to be clear, where did the fixed MOH go? If you notice, the fixed MOH was included in the total MOH here and figured out as a per unit item. So it was included as a per unit cost. So now we're going to move down to variable costing, and it doesn't look different, variable costing, but notice we've got a couple more categories. We've got the sales revenue, and I'm not going to recalculate, that's just done the same thing. Same way, $49 times 13,000 sold. But you notice we've got two different things. Rather than having gross profit, we have an intermediate total called contribution margin. And we'll deal a little bit more with that in chapter 7 and 8. Contribution margin is the rather than gross profit, we're actually more interested from a decision-making point of view on contribution margin. So you can see a little bit here, instead of having one in each of these categories, we have two. And you notice that they're the same. Here we've got variable COGS, in other words, taking out the fixed portion of MOH, and we've got variable operating expenses. Normally we did that after gross profit. And so this time, so these are both variable. Variable this, and these two are fixed. The fixed part of MOH, and we could actually say the fixed part of COGS, but remember COGS is direct material, direct labor, and MOH. So what we're doing is basically saying MOH is broken up into a variable and a fixed part. We're going to, for the COGS is going to be the variable part plus direct materials plus direct labor, and we're going to take this fixed part and move it down here, or move it to here. And then what we're doing with the operating expenses, if you remember up here, we calculated the variable part and then we were given the fixed part and we added them together. And we're going to split them apart here. Okay, so let's, just like before, let's figure out the variable COGS proportion, the variable COGS part. So we're given total MOH, 221 here. And we're given the fixed part, which is 187. But if we want to come up with a new cost per item, remember up here, we figured out a cost per item, which had an MOH including the fixed and the variable portion, right? So this is the direct materials, this is the direct labor, and this is the fixed plus variable part. And what we want to do is we just want to figure out the variable part. So we've got to strip out this fixed part from the per unit cost. So that's what we're doing. So we're saying we know what the total is, we know what the fixed part is, therefore the variable part is 34,000. So if the variable part is 34,000 and the number of items I manufactured was 17,000, well, what we're saying is the variable part, whereas before we said the total MOH was $13 per unit. But we're saying of that $13, only $2 is the variable part. So let's recalculate it according to variable costing. Well, we're going to use these same numbers. The direct materials and the direct labor does not change. But rather than using the total MOH per unit, we're going to just use this. We're just going to use this variable part too. So that gives us a total cost. And this is the, per the variable costing method. And this is going to be 26. And the number of units sold is 13,000. And the COGS under this method is 338,000. So just to remind ourselves, the COGS under the other, where we included the fixed manufacturing, was 481. So already we're seeing a little bit of difference here. So we'd say the variable COGS part, well, I didn't write that 3 very good. Okay, so pulling this down, We had already figured this out. We just figured out the 338. Now we need to go ahead and figure out the rest of these guys. So the variable operating expense, well, we had done that previously, but let's, rather than scrolling back out, I'm just going to show you that you're given the numbers pretty clearly. So here, the variable per unit sold, and focus on this. It says per unit sold. So if you're kind of questioning whether or not it's per manufacturing unit or if it's per unit sold, a lot of times they'll give you a hint. So 3, and how many units sold? Well, 13,000. So our variable operating expenses are 39,000. When I subtract that out, our contribution margin, not our gross profit, our contribution margin is 286. Okay, we're given the fixed portion of manufacturing overhead. Remember, we had to calculate the variable part, 187. And we're given the fixed part of the operating expenses, which is 47. And that, once we figure that all out, comes to 26. Now just be aware, this operating income looks a little different than this operating income. This operating income said 70,000. And as I said before, it's not immediately obvious, but we multiplied the fixed part of the manufacturing here was stripped out and was calculated slightly differently than how it was applied here. So if you have further questions, if you're an accounting student, about exactly where everything went, I'm happy to show you. Just realize, at least for most of the class, that the numbers are going to come out initially looking a little different, but over time they merge together, because like I say, it's mostly just a timing issue. It's when is it manufactured? There's a calculation about when it's manufactured versus when it's sold, and those numbers are slightly different. But in the end, everything you manufacture, or at least in these sort of problems, you end up selling at some point. Even if you calculate the overhead for manufacturing this period on one thing, and you calculate it for it in the period that you sell it in the next period, in the other version. Okay, so they will come out a little differently. Just don't doubt yourself. Just make sure you follow through and do these calculations the correct way, and you will get the right number. So there's one last thing that we need to do is, okay, remember, cost of goods sold was partly for figuring out the income statement, but also under financial account, it's not only the cost of goods sold on the income statement, but what is the ending inventory on your balance sheet? And we still need to kind of figure that out. So here are the two different types of costing systems: the absorption, which is GAAP, and the variable, which is our managerial kind of decision making. So under both of these, we manufactured 17,000 items. And we sold 13,000 items. But the way we figured out the cost is a little different. Under this one, we put all of the fixed manufacturing on the unit. And here we only put the variable portion, and then we subtracted out the fixed MOH later on. You can see this is where we subtracted it out later on. So it just shifts the costs from the balance sheet to the income statement, or vice versa. And like I say, it ends up washing out in the end. So the ending inventory under one regime is 148, and the other one is 104. So they have sort of an odd question at the very end. So let's just try and I've kind of highlighted here, and so the main thing we're focused on is the fixed MOH. That's the thing that's calculated differently between the two. Under absorption cost, it becomes part of the product cost, right? That's why this is higher. Under absorption, the fixed MOH is included in the cost per unit. Under variable, it is pulled out and expensed as a period cost. That's this right here. So Now, they say it generates higher operating income. Well, in that particular month, if that ends up being the way that it shifts. So it could go either way. So that's why I say it's a little bit of a tricky question. Just remember, absorption has the fixed MOH as part of the product cost. Variable has the fixed MOH as part of the period cost. Okay, so like I say, question 10 is all these same questions but asked in a slightly different way. But you can go through and pick through these answers and be able to answer question 10 as well. As always, if you have any questions, please email me or come visit me during the online office hours. I did mention that I will be doing a special quiz video for each of the different chapters. I think the next thing I'm going to do is actually do chapter 7, and maybe because I'm still trying to formulate how I would like to. I'm not going to do obviously question, but I'm not going to do it the same way where I do question by question for the quiz video. I'm probably going to do something more of here's the types of questions you're going to get, and this is what you should be looking for, without actually directly showing how to calculate the answer like I do with the homework. Okay, any questions, please let me know. Thank you.